Hey, Nicholas.stromberg here, and today is July 18th, 2025. Just going to take a real practical look at mortgage insurance. I want to show you the actual examples while I'm talking about it, more so for conventional loans because it varies versus FHA loans. We'll kind of take a look at some differences. FHA has some additional costs. We're going to look at this straight up conventional wise without any down payment assistance programs, but we'll also check out the first time home buyer rates, and we'll look at different loan amounts, and we'll show you what that mortgage insurance payment is at each of these levels as we work through this today. So buckle up. I don't know if you need to buckle up, but let's take a look. Today's date, Friday, July 18th, and we're just going to do a quick spin through and look at the rates first of all. For these scenarios, we're going to use Minnesota, $500,000 purchase price, $475,000 loan amount, $740 credit. This is a first-time home buyer. For this right now, I'm going to put no, just so we can see what these rates look like real quick as we do a spin around and compare them. At 6.625%, points are 0. When we do the first time home buyer, this is going to get better. However, I just wanted to show you compared to some of the competition out there. What is the monthly mortgage insurance? It's $146 for that particular setup with a 740 FICO score. All right, going back, same exact scenario, 500,000, 5% down. This is at Bank of America at 6.625% for the same exact setup with a 740 FICO score. We are looking at 0.993 points. Right there, just in terms of the rate is almost $4,750 more than mine. Over at Wells Fargo, same exact scenario, 740, 1 point, $4,750 due at closing. And that is the cost of the rate. Chase Bank, what do we have? Same exact setup, loan amount 475, 6.625% rate. Let's see what these details show us. They've got a processing fee of $13.95, mine is 0. And the points are 4,500. Mine was also 0. These are all non-first time home buyers, but I wanted to start off with that just to show you some comparisons of just where we're at in the market. I've done that comparison before on other videos. 5% down, first time home buyer is now included. I've got the AMI rate discount. Now, what do the rates look like? What is the true difference? Same exact setup, 740 FICO score. Before with me, it was 6.625 with no points. Now it's almost a $3,000 lender credit at that 6.625 marker for a first-time home buyer. The 10-year has gone up 4.42%, up and down and up and down and up and down. Whatever rate we choose, the mortgage insurance will be the same. This is your principal, interest, and mortgage insurance monthly payment. The monthly payment, mortgage insurance is $146.85. That is with 5% down and a 740 FICO score. Now, with conventional financing, there's 3 tiers of mortgage insurance: 5% down, 10% down, and 15% down. What you pay for mortgage insurance, it's based on how much you put down, but also what your FICO score is. So the higher the FICO score, the better. Now, let's take a look at this exact same scenario. If we were at 800 or higher, what does that do to our monthly mortgage insurance? I think we were at 147 right now. So let's refresh that with that higher FICO score. Now it's $105 per month. So in this scenario, you're able to get into a $500,000 home with a $25,000 down payment. Now, of course, you're going to need more than $25,000 if you elect to pay for a rate. That's in addition to what you pay. If you elect to get a lender credit, this counts towards your closing costs. This offsets closing costs, but then there's title and escrow fees and all of those things. But we're focusing on payment. So a lot of times people can qualify for the monthly payment. They just don't have the cash, or they have a certain amount of cash, but they don't want to make a certain monthly payment. So this is where all of this comes into play. If you are a little bit cash strapped, but you still want to own a home and you can get in as a first time home buyer and you can qualify for a $475,000 loan, your monthly payment, principal, interest, and mortgage insurance at 6.625% is $31.47 per month. That's $106 per month in mortgage insurance in exchange for keeping 15% in your pocket in terms of a down payment. So at $500,000, 15% is $75,000. Now, if we had that lower loan amount, if you put down 20%, yes, of course, your monthly payment's going to be lower because you put down more money. Also, is it a fixer-upper? Maybe you want to get into this house for as little down payment payment in as little cost as possible. Save your stash of money, put down 5%, get in, make these monthly payments, not that big of a deal. Remodel the house in 6 to 12 months whenever the remodel is finished. Then go back, do a rate and term refinance. Now the value of your house has grown. Your loan to value position has changed because your loan amount is still in the same range, but your value has gone up like this. So now your LTV is in a better position. Maybe when you refinance, maybe the appraisal comes in at a marker where now you've got more than 20% equity. Now you can just drop the mortgage insurance altogether. So that's something as well. But what I want to show you is just the different levels. We saw 740. Let's see what it's at for the 760 bucket. Okay, 760 is still in that 105 range. That's going to be the same for the 800 or higher. Basically everything over that was in that range. 720, let's see where that's at for that monthly MI. Now we're at 183 for 5% down. 700 FICO. Now we are at 216. And as you see, it's going to benefit you to have the higher FICO score. There's also FHA loans. FHA loans have mortgage insurance no matter what. It's a set number. They will usually have a lower face rate, but they're going to come with that mortgage insurance whether you put down 20%, 30%. They're a little more flexible in terms of what they allow with debt to income ratio, but FHA loans, they've got a big upfront mortgage insurance premium, 1.75% of the actual loan amount, and that gets tacked on, or it can be paid in cash, but it gets to be very expensive. Their leading rate is lower, but then kind of look at the total payment and then you look at the cost of what it is. If you have a good FICO score and you don't have that 20% down payment, you're probably going to be looking at a conventional loan. The face rate might be a little bit higher, but your monthly mortgage insurance will be less and you will not have that upfront mortgage insurance premium. So $475,000, that's a fee that is paid to the HUD to do the FHA loan, 1.75%. This actually gets added on to the $475,000 loan amount. So the loan amount would actually be 483. So you see the face rate's a little bit lower. It shows the lender credit here is a little bit better. However, you've got that giant 8312 fee that gets tacked onto the end of the loan. And then with FHA, your mortgage insurance is going to be based on a percentage. So your monthly payment might even be higher because your loan amount starts higher. The face rate's a little bit lower, but no matter what, you've got that mortgage insurance. The monthly mortgage insurance, you can see the basis points, what it is. It's standardized. It's not like the conventional loans that we've been looking at, where it matters with the FICO score and how much you put down. These are standardized. You're either going to have that mortgage insurance for 11 years or 30 years. Back to mortgage insurance for conventional loans. Let's look at 10% down versus 5% down. And then let's also look at 15% down. If you put down 10%, 450, everything else remains the same. Now the loan amount is a little bit lower, so the monthly payment will be lower. $74 a month. That's not that big of a deal. Do you want to put down $100,000 or do you want to put down $50,000 and then pay $74 per month? The principal and interest payments will be higher just because it's $450,000 versus $400,000. As properties appreciate over time, you refinance to a better rate later on, you're going to be able to scrub this out. And conventional mortgage insurance, it'll be there typically for a minimum of 2 years. It'll automatically be removed when you have 22% equity, or you can ask for it to be removed when you believe you have 20% equity or so. Typically, the mortgage insurance providers want it to be on there for 2 years. But let's go back to the 10% down. First-time home buyer, yes. So here we've got $74 per month. Now let's just roll down the line and let's see how this changes with different FICO scores. $100 per month if your credit's 740 to 759. If your FICO score is 720 to 739, now it's 121 per month. 700 FICO score, now we're looking at 144 per month. Still not the end of the world, but gets you into the house. Principal, interest, and mortgage insurance. This does not include your taxes. This does not include your insurance. So we've been working through this, 10% down. And let's just go to like 680, 171. You still get the 6.5% interest rate because of the first-time home buyer incentives. It puts a cap on the loan level pricing adjustments. So if it's a non-first-time home buyer, you would see these rates be much worse as the credit score goes down on a conventional loan. Let's take that out of there and let's just see what this is. Yeah, so we're 6.875 is par with no points. I can't imagine what this would be with the other banks. I'm not going to price that out. Let's put that back on and we're looking at the MI 171. Okay, now let's pretend your FICO score is 680. You're all in for $3,015 for principal, interest, and mortgage insurance, not taxes, not insurance. But then let's look at this. And so 171 is the mortgage insurance. Now let's change this over to FHA. You've got the big upfront funding fee, $7,875 for 10% down. Your rate is 6%. You actually get a $1,378 lender credit. So this is better. This is better. This monthly payment is actually better as well. The mortgage insurance is a little bit higher. It's about $10 more per month. But the problem with this one, the funding fee. The funding fee is $7,875. So in a situation like this, if you would opt for the FHA loan, the rate is lower, the monthly payment is lower by $82, even though the rate is like a 0.5% lower, but the loan amount is higher because you're adding this huge upfront mortgage insurance premium into it. This versus the other one, it costs like $7,000 more. With FHA also, that mortgage insurance factor, it's a percentage and it's going to be there. It's just going to apply to the different loan amount. So like if you have a lower FICO score, the MI will be better with FHA because it could be really bad with conventional if you're only putting down like 5 or 10%. We're going to slide back to conventional. Now we're going to put down 15%. Now your mortgage insurance is only $47 per month. Still, the rate is in that 6.5% range with a credit. We've got a $425,000 loan on a $500,000 purchase at 6.5%, $2,733 per month. That's not so bad. $47 for putting 15% down. You know, maybe you want to save that extra 5%. Maybe you were planning on a 20% down purchase, but you want to have money left over when you're done. Hopefully 10, 15,000 or a nice little cushion so that you can furnish your house, utilize whatever extra money you have to make it comfortable. Let's go back. Let's just look at a few more levels and then we'll wrap this thing up. We are back to 15% down. Now let's go to 740. Now the MI, it's only $3 more per month, $50 per month, 720, $57 per month. So it's not making as big of a difference here. See, it makes a bigger difference when you put down 5% or 10%. As your equity position rises, the credit score is not affecting the monthly mortgage insurance as much as when you had a lesser down payment. Let's go to 680, $69. So here, even 660, I don't know what this is going to look like. First time home buyer getting $1,000 lender credit at 6.625% and paying less than $100 in mortgage insurance. That's pretty dang good, actually, in this current marketplace that we are in. Do we want to see what FHA looks like at this same exact marker? So we got $1,000 lender credit, 6.625%, $2,816 is our monthly payment with a $94 per month mortgage insurance payment right here. FHA, the rate's going to be lower. The MI may be higher. So the rate is actually 0.625% better. Significant. A similar lender credit. Monthly payments a little bit lower, but that MI factor is much higher. So even at 660, our MI was like $94 per month. And again, that's based on your equity position, your credit score, putting down 15%, but also first time home buyer. So some incentives helping out there. So technically you can pay less per month on this FHA setup, but the difference in monthly payments only $46. And that's because the mortgage insurance is higher with FHA loans. It's $177 on this one. On the other one, it's $94. But also, you've got this premium, $7,437 that was added into your loan amount. If I'm your advisor, I would say, hey, I'd still recommend the 6.625 conventional loan. It's got a $46 more per month payment. The face rate looks different, but the MI is lower. But the MI also will fall off much sooner if you don't refinance out of this and you don't have this big fee to deal with. So that is a look around at what various levels of mortgage insurance actually look like for a purchase of $500,000 with 5, 10, 15% down. You can do this on my website. You can get these scenarios yourself, www.greatrates.io. This is a way that you can come in and identify some of this and see if you are truly ready. And one thing you can even do on my website here is under resources, qualification mortgage calculator. This is very high level. This is very general. It can kind of give you an idea if you can qualify for a home loan. I always say, let's talk first because I'll be able to help sharpen this up way beyond if you're just kind of swimming around. Thank you for your time. I appreciate it. At Mortgage ABCs on YouTube, www.greatrates.io. Have a great day. We'll catch you later.